Welcome. We're talking about the in-class problems for Chapter 9 in the Kieso text, Wiley. And the first one, as we can see here, is exercise 9-6. And it's supposed to take us 35 to 40 minutes to finish, so hopefully it won't take us quite that long. We're instructed to prepare all the journal entries necessary, including the December 31st year-end entries, assuming these investments are accounted for at fair value through net income, and interest income is not reported separately from other related investment gains and losses. The second question is to assume that Wildcat manages these investments based on their yield to maturity, which is essentially the effective interest method, and prepare all the journal entries that you consider necessary there, including December 31st adjusting entries. And then briefly explain what it means to manage an investment on the basis of yield to maturity and why the recommended accounting method is reasonable in such a situation. That's basically just a discussion, so we'll discuss that when we get there. So if you want to take a snapshot of this screen, that would be good, and then you can refer back to it, or of course you can look at it in your own textbook through Wiley+. I just lost my page. Alright, so that's as soon as I get back to where I left from. Alright, here we go. So, first of all, on February the 1st, we're doing part A here. On February the 1st, the company purchased Gibbons Corp bonds. They were 10% bonds with a face value of $300,000. They were traded at 100, which means, of course, they were traded at par. So the present value, we paid $300,000 for them, and it says at 100 plus accrued interest, and interest is payable on October 1st and October the 1st. Did I say April 1st and October the 1st? So on the February 1st date, we've had the bond outstanding for October, November, December, January, for 4 months. So we owe the seller of the bond 4 months of interest at 10% per year. So we have to figure out what the accrued interest is. So let's start with the debit to fair value through net income investments. Oh, we need a date, don't we? Yes, okay. Let's put in a date. Insert a couple of lines and insert a column. Alright, so this is 1 Feb. We don't have a date, we don't have a year, so we'll just shoot the 1st of February. So the fair value net income through investments includes $300,000 at face value. It says we have interest receivable for $10,000. So how do we calculate that? That's a good question. How do we type that? Another good question. Well, we need to take the 300,000 and we need to multiply that by 0.1, and then we take it times 4 out of 6. Out of 12. 10% is the annual rate. Now it doesn't really matter whether the interest is paid annually or semi-annually. We just calculate from the last coupon payment. So in this case, we would have last received the payment on October the 1st, and since we're using the 10% rate, we would basically be getting $30,000 for the year, so 4 months out of the 12. We could also do the calculation as 10 divided by 2 times 4 out of 6. That would result in exactly the same result. So I'll show you that here. If we take 300,000, that's enough zeros, times 0.1 divided by 2 times 4 out of 6, we end up with 10,000 there as well. So in the language of the bond market, that means that we have to pay we have to pay the owner of the bond what we call the dirty price, which is 300,000 plus 10,000 of additional money. Boy, I'm fighting with this. Let's put the format for both of these as that, and then minus a couple of decimal places in there. That should work out. Okay, so and then we can make these a little smaller. Just double click on the right hand side of the column, and it makes it the right size, which is cool. So we need to pay $310,000 for this bond. We're going to receive a $15,000 coupon on April the 1st, which is only 2 months from now. But if we didn't pay the owners of the bond their share of the coupon that was outstanding, they would basically be giving up all of the income from the last coupon payment. So we pay them the clean price if we buy the bond on the date of the coupon payment. But in this case, we didn't. We bought it 4 months later, so we have to calculate the accrued interest, which we refer to in finance as the dirty price. Just a bit of a reminder. Of course, we need to pay for this bond, so the payment, of course, is going to be cash. So that was the first transaction. Then it says the next transaction on April the 1st, semi-annual interest was received on the bond. So this is on the 1st of April. We received some cash. Always nice to receive some cash. And we reduce our interest receivable. And we also receive some interest income. Now the interest receivable wasn't interest income because it's just we paid for it. And so the amount of cash we get is actually 300,000 times 0.1 times 6 over 12, or 15,000. Of course, 10,000 of that is for the interest receivable, and the rest is the interest income. You could do the calculation for this one by taking the 10% and figuring out how much that is for 2 months out of the 12. But it's just the balancing figure. Alright, back to the next part of the question. On June the 15th, Samsung Inc. bonds were purchased. They're 9% bonds, $200,000 par value. Were purchased at 100, so once again we purchased them at par. And the interest dates are June the 1st and December the 1st. So on June the 15th we purchased them. We have a very small amount of interest receivable. So we buy for value through net income investments, and it was for 200,000. And the interest receivable IB for E except after C. Okay, good. Would be equal to 200,000 times the 0.09 coupon rate, and we've had them since the last coupon payment was June the 1st, so it's 15 days, so times 15 out of 365, or we could make it, let's see what that works out to, 740. They have 750, so they're using months apparently. So let's go back to the months. We have 0.5 of a month, out of 12, and that works out to 750. So then we credit the amount of cash we have to pay, which is the total of those two, 200,750, and we're good. Then August 31st, Gibbons Corp bonds with a par value of $60,000 were sold at 99, and Gibbons, of course, were these bonds up here. And so if we sold them, we sold bonds with a par value of $60,000. So we didn't sell all of them on the 31st of August. But we did get some cash. And so we sold them at 99. So 60 equals 60,000 at 0.99, which is what that means. And it says we sold them at 99 plus accrued interest, so we have to build in the accrued interest. That's 60,000 times 0.1, and August 31st, the last payment was April the 1st, so it's April, May, June, July, and August, so 5 months. So times 5 out of 12 is the total amount of cash we got, 61,900. And we bought them at 100, so we're selling them at 99. So there is a loss involved with that. So we have an investment loss. And that's going to be equals 1 minus 0.99. Whoops, didn't like that. No. Alright, so I need another bracket. Times 60,000. So it's a $600 loss, and loss is always debited. And so then the credit is going to go to fair value through net income investments. 60,000, and that doesn't quite balance, so we've got a $2,500 difference. What would the $2,500 difference be? It well, part of it is we received part of the cash for interest income, so I think it's interest income, which that would explain the 1900. No, it's actually let's think this through. The interest income is actually, let's do the calculation since we can. It's times 0.1 times I think we figured out 5 months out of 12. So that's 2,500. So I didn't actually follow my procedure of indenting these. So let's do that. Alright, so the 31st of August entry is shown here. And it's balanced, so that's good. Essentially, the 2,500 is the interest income. So if we look back here to the formula, which we can see up here, this portion represents interest that we've earned, and we're not going to get paid for that because we aren't going to have the bonds at their next maturity date on October 1st. So we're going to charge the purchaser of the bond that in order to recover our share of the coupon payment. So that's what the 2,500 is. The other 60,000 times 0.99 is the sale price for the bond. Moving along then, on October the 1st, semi-annual interest was received on the remaining Gibbons Corp bonds. So this is on the 1st of October. We got some cash. Cash is always nice. Alright, so the amount of cash we would have gotten is, since we only have, well, let's do the calculation. 300,000 minus 60,000 So we have about 240,000 of bonds left, times 0.1, times, well, 6 out of 12. Is the amount of cash we got, and of course that's going to be interest income. And then the next entry is on the 1st of December. Semi-annual interest was received on the Samsung bonds, and that's these ones up here. And so we're going to get some cash. Cash is always nice. Let's remember our accounting language here. Okay, interest income. And the amount of cash we're going to get is 200,000 face value, give me equal sign, times 0.09, times 6 out of 12, or 9,000. And when we bought them, we had interest receivable of 750, so we need to remember that as well. So 750, and the interest income we earned is just the difference between the two. Or we can calculate it based on the time period as well, but that should work. And then the final journal entry, on December 31st, the fair values of the bonds purchased on February 1st and June 15th were 98.5 and 101 respectively. So we're at the end of the year. We need to figure out what the fair value of these bonds are, because they are fair value through net income investments. So we need some debits and we need some credits. And we need to record the amount of interest that we're due to receive. So interest receivable, and that would include the let's do brackets again. Whoops, step back here. 300,000 minus 60,000. Those are the Gibbons bonds, times 0.1 times the last interest payment from them was October the 1st. So then we have earned October, November, December, 3 months since then. We also have earned some interest on the Samsung bonds, and the Samsung bonds are at 9%. 20,000 times 0.09 times 1 month, because their interest payments are on the 1st of December. So that works out to 7,500, and we record the interest income. Same amount. Just reviewing the instructions for the first part of the question, it says that interest income is not reported separately from other related investment gains and losses. So that means that rather than calling it interest income, we should refer to it as investment income or loss. So how's that going to change things? We have an investment loss here, so let's just report it as investment income or loss. That's what the solution manual uses, so we'll just use that. And so every one of our interest incomes here, we'll stick that in there instead. And here. We're not quite done with this one because that's just recorded the interest up to date. And then of course we have to recognize the fact that the fair value investments have changed in value. So fair value through net income investments, well, we're not actually sure which direction they're going. So let's calculate the value of the fair value of net income investments, and then we'll subtract the. So let's assume it's going up in value. 240. No, it's going to go down in value. We can do a little side calculation if you like here. Price. How about original price? Origin. Be nice if I could type while thinking. And then current value, and then change. So we have Gibbons, and we have Sampson. The original price paid for the Gibbons was the 300,000 minus the 60,000 that we have left. They were traded. They were purchased at par, and Sampson was also purchased at par of 200,000. Okay, looks like we need some formatting here as well. Let's do that quickly. Alright, so the current value for the Gibbons is 98.5. So 0.985 times, well, 300,000 minus 60,000. And the Sampson bonds are trading at 101. So for some reason they went up in value, and the Gibbons bonds went down in value, which is kind of unusual. But it could be that we've changed the credit worthiness of Gibbons or Sampson along the way. So Sampson, we own 200,000 of them, and they're now trading at 101%. So we've made money on those and lost money on the others. So just calculate the change between the two. We'll take that one minus that one. Lost money on that one. And we'll just copy that down. And then we'll add them up. And hit enter. And then put our little accounting niceties, double underline, top and double bottom border right there. That looks good, eh? So then we go back over here, and the the total fair value of net income investments went down. So the investment income or loss is going to be a loss of 1,600, and the fair value through net income investments in bonds is going to be decreased by 1,600. So that's part A of the question. And that took us 23 minutes. But we're not quite done yet, because we have to do part B. It says, assume instead that Wildcat manages these investments based on their yield to maturity. Prepare all journal entries that you consider necessary, including December 31st adjusting entries. So I think what I'm going to do here is I'm going to put a label on here. I'm going to say A, and then I'm just going to copy the sheet because I think a lot of the numbers are going to be similar. So rather than retype everything, we'll see how that works out. Oh, okay, cool. Double click on there, go to the end, back it out, B, and then we can move it over to the other side so that it kind of makes sense. Alright, so it says that assume that Wildcat manages these investments based on their yield to maturity, and we're going to prepare the journal entries once again that we consider necessary, including the December 31st adjusting entries. So since cash has changed hands in most of these except for the very last journal entry, we're going to have the same number of journal entries, but some of the pieces are going to be different. So for starters, the amount that we pay for this first investment is going to be exactly the same. So the heading, though, is not fair value through net income investments. When we're managing them based on their yield to maturity, that's an amortized cost method. So we are going to debit bonds at amortized cost. And so we originally purchased them at par at $300,000 and paid the dirty invoice price, including the $10,000 interest receivable, and we paid cash of $10,000. Then on April the 1st, we received the interest, and we recorded the investment income or loss under the previous consideration. That wouldn't change. It would be exactly the same because we actually received $15,000 in cash as a coupon payment. Then on June the 15th, we bought some more, and again we're going to call those bonds at amortized cost. And we also had some interest receivable there. So the cash was $200,750. We paid for it. Now August the 31st, we can just call it investment loss. They refer to it as loss on sale of investments. So I suppose we did sell these investments. So that title makes sense. And of course our bonds at amortized cost would go down, and the interest income would be characterized as interest income. I guess we didn't do that right up above here either. So this should also be called interest income, not investment income. Okay, that gets us all the way to there. And then on the 1st of October, the semi-annual interest payment was received, and that's just interest income. And that would be true for this one as well. Whoops. Let's undo that one. Control Z. Undo. Investment income or loss, that would be interest income. So that's the amount of coupon that we earned, and the interest receivable is just the interest receivable that we set up here. Alright, now, before it gets a little bit tricky, on December the 31st, we're going to have to actually calculate the amount of the bond value. Now, this situation is a unique situation because we actually traded the bonds at par value. So, at par value, the face value of the bond is equal to the purchase price, but it's also true that the coupon rate is equal to the bond yield to maturity. So, if they were actually different, we would have to do some additional calculations, which I expect we'll be doing in future questions, where we actually have to calculate the effective interest. Essentially, we're using the effective interest method here, but there's no difference between the coupon rate and the yield to maturity for the bond. So, on December 31st, the entries that we make are essentially the same as these entries, except this is interest income. And under the amortized cost method, because we're expecting to keep the bonds to maturity, otherwise we wouldn't be able to use that method, the investment income or loss, we're not actually marking them to market. So in Part A, here, we make this adjustment at the end of the year because we're recording them as fair value through net income investments, which means that when the fair value changes, as it did here, we actually need to record that as investment income. When we're recording them at amortized cost, there is no requirement to record them through fair value through net income, and so we wouldn't make that entry. And that would be that. So then the final note briefly explain what it means to manage an investment on the basis of yield to maturity and why the recommended accounting method is reasonable in such a situation. The idea is that the bonds are going to be held to maturity, so any short-term changes in value are not really relevant, because you're going to just be collecting the coupon payments and therefore earning interest income until the time at which the bond pays its the bond issuer pays the face value of the bond. So all of the cash flows that they're going to receive will just be cash flows from interest. The price doesn't really make any difference. So because management does not intend to trade these bonds in the market, remeasuring them to fair value is not relevant to the users of the financial statements. And that's it for problem 9-6. So now we can move on to problem 9-10. Actually, I'm mislabeling them. They are exercises. So as you can see with the E, E stands for exercise. So here's problem 9-10. It says to prepare the adjusting entries, if any, at December 31st, 2017, assuming the investments are acquired for trading purposes and accounted for using the fair value through net income model, with no separate recording of dividends and other types of fair value, net income, investment income, and losses. So that's similar to 9-6 part 8. Then it says prepare the adjustment entries, if any, assuming the assuming the investments are accounted for using the fair value through other comprehensive income model. So fair value through net income versus fair value through other comprehensive income. And then discuss how the amounts reported in the financial statements are affected by the choice of accounting method. I think that should be fairly obvious by the time we're done the journal entries. So take a snapshot of this, or a screen capture of this this question, or look it up in your Wiley, and we'll continue. So we need another spreadsheet here. Here we go. Exercise 9-10. I'm thinking that maybe we just want to make a copy. Just a second. All right, I'm back. I just made another copy of the bracket for some reason. I've basically retained the formatting from the previous problem to save us a little bit of time. So here we go. The following information about KO Corp's investments at December 31st, 2017, and we purchased 3,000 shares of Petra Corporation for $40,000 back in the original purchase date. The fair value now is $46,000. We bought 1,000 shares of Dugald Inc. preferred shares for $25,000. We're losing money on those. $22,000 is the fair value today, so the value has gone down. It says assume that KO Corp follows IFRS and applies IFRS 9. So part A says prepare the adjusting entries, if any, at December 31st, 2017, assuming the investments are acquired for trading purposes and are accounted for using the fair value through net income model, with no separate recording of dividends and other types of fair value through net income, investment income, or losses. So if we receive dividends on these shares, we would record them as investment income and losses. But we actually have a balance sheet date here, so on the 31st of December, we have to record the change in value. So we'll do that separately for the two accounts. No, we won't. We're just going to adjust fair value through net income investments. Now the total value of the two has gone from $65,000 up to $68,000. So I can't remember which one we actually changed the format for here. I think it's this one. Let's quickly check. H and I. Okay, so in H, that should work. We have $68,000 is the value now, minus the $65,000 we paid originally. That's a $3,000 gain. And so the investment income or loss is the other side of that transaction. Fairly straightforward. Part B, the difference is that we're using fair value through other comprehensive income for this one. So same date. Debit, in this case, fair value through other comprehensive income investments. And it doesn't actually go through the income statement. It goes through the unrealized gain or loss in other comprehensive income account. So that's 3,000. Note we've included them both together. We could actually set them up as two transactions. So we recorded a gain on the Petra shares and a loss on the Dougal shares. The gain on the Petra shares would be 4,000. The accounts would be exactly the same. And the Dougal shares had a loss of 3,000. So the net of those two plus 6 minus 3 is the 3 that we show here. Final piece there. Describe how the amounts reported in the financial statements are affected by the accounting method. Well, the amounts are obviously the same, but the reporting, the net income, the first one, part A, investment income or loss would actually be used to increase income, the net income number. The part B, using fair value through other comprehensive income, means that we don't actually record the gain or loss until we sell the bond, and so we keep it in the other comprehensive income, which is part of shareholders' equity. And we have an account called accumulated other comprehensive income down there, and it will grow or shrink depending on the total gains or losses until we actually realize the gain or loss. And when we use the term realize in accounting, of course, that means that we have actually exchanged it for cash, or somehow exchanged with a third party for a certain amount of value. And the reason this is unrealized is because we haven't sold them yet. So the investment income or loss in part A would be included in well, either ordinary income if it's an investment company, or it would be included in other revenues and gains if this investment income is not really it's not central to what they're doing, and they're just investing some extra cash for a period of time. And so the net income would include other revenues and gains, and then that would be close to retained earnings, as all other net income items are. The fair value through other comprehensive income model would result in an increase, in this case, an increase in the accumulated other comprehensive income account, which is part of the shareholders' equity section as well. And for equity investments, such as these are, the note says the holding gain or loss is never recycled to income under fair value through other comprehensive income for equity investments, and both the fair value OCI and fair value net income securities are reported at fair value on the balance sheet. So that's the reason for the debits in both those journal entries, is to adjust the value, the carrying value of the assets to their current fair value. And that's it for Chapter 9, Exercise 10.